One of the biggest underwriting mistakes is underestimating expenses. Small expense mistakes can erase hundreds of thousands of dollars of value in an instant. One thing I've noticed over the past 2 decades is how experienced investors and underwriters utilize expense ratios while some beginner investors simply overlook them. Welcome to Strategy Saturday. I'm Charles Crillo. Today we're discussing how expense ratios kill deals and how they can actually save them when you know how to read between the lines. So let's get started. Previously in episode SS277, we discussed the basics of what an expense ratio is in the context of multifamily real estate investing. And in this episode, we're going to take that one step further. As a quick recap, the expense ratio is determined by dividing operating expenses by the gross effective income of a property. The rough rule of thumb is that multifamily properties should have an expense ratio of 40% to 60%, and the expense ratio will be lower for newer A-class properties and higher for older C-class properties. B-class properties should be right around the 50% mark. But like real estate in general, expense ratios are hyper-local and can differ by submarket. In multifamily investing, the expense ratio is a quick underwriting metric that gives a glimpse into the operations of a property. For beginners, it can be overlooked, whereas a seasoned investor who understands common expense ratios in their market might notice an opportunity. So how do expense ratios kill deals? Well, expenses greatly affect the value of a property. If you're looking at a property with a 5% cap rate, every $1 in expenses that is not accounted for reduces a property's value by $20. It's easier to verify a property's income, but harder to verify a property's expenses. If you're reviewing a seller's T12 or trailing 12-month statement, you will see the gross income, and you can verify that by cross-checking the property's bank statements. Pretty straightforward. But when reviewing expenses, it is harder to see if the seller is making them look lean for sale to boost the value of a property and deferred maintenance awaits the buyer, or if they were really fixing a lot of issues throughout the year and the property has minor deferred maintenance remaining. Additionally, if repairs are higher than normal, it might indicate constant patching, which may require an actual replacement. Reviewing current expenses with the property management team and walking the property will give you clarity on the property's true condition. Property taxes are a common deal killer, especially if a property has been owned by the same owner for many years. Estimating the new tax bill at the time of purchase will give the buyer a more realistic estimate of the expense ratio. So how do expense ratios save deals? Normalize the expenses of the deal, provide an honest opinion of how much it will take to operate the property. What line items can be decreased? If you own similar properties in the area, these opportunities will be more apparent than to first-time investors. Do all this without changing the property's current gross income and see how the deal looks now. Are there any operational inefficiencies? Is the seller paying for all of the utilities out of pocket? Are they overpaying for payroll or management, which is very common with seasoned owners who are making money and not interested in making changes that could negatively affect the time they devote to the asset? In multifamily investing, you want to look out for expense ratios that are outside of the market norms, expenses that are not in line with industry averages, and underwriting that has not been adjusted for the estimated new taxes and insurance premiums. Expense ratios won't make a bad deal good, but they will quickly expose it. And that is exactly why we reference them early in underwriting. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate, but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.